Welcome back, everyone. I do see that there are lots of questions coming in, and it just demonstrates how fully engaged we are. So we do thank you for that. Keep them coming. If we do not get to them, please rest assured we will have a mortgage representative reach back out to you directly, so you will get your responses. Remember to use the QA feature on your screen to continue to submit those questions. And with that, we want to move on to our second session, the home buying process. And I'm glad to bring Chip back in to take us through this presentation. Welcome, Chip. Thank you. Please do
Thanks.
through the
Yeah,
home.
thanks so much, Sylvia. And thank you to all of our attendees for coming back for round two. Yeah, I'm so glad we've got so many questions coming in. That's great, and keep them coming. And I hope that this presentation will bring up even more questions for you, and hopefully answer a lot of them also. So for the home buying process, what are we going to cover? We're going to talk about choosing a property, and that's twofold, meaning choosing a different type of the different types of properties that we offer home loans on, houses, condos, etc., and also how you own that home, whether it's a primary residence, a second home, an investment property. We'll discuss the different types of mortgage loans that UNFCU offers: fixed rate mortgages, adjustable rate mortgages, which ones might work best for you. We'll talk about some promotions and reward programs that the credit union offers. Some of these are available all the time, 365 days a year, and some of them are brand new. We have two that are just being announced today, so we're really excited about telling you about them. And we'll wrap up this section of the event with a discussion about how you might use your home in the future or to finance other needs. And we'll get to that in just a bit. Let's start off again, though, with choosing a property. So when you buy a home, you could buy that property as a primary residence, which sounds like, oh, that should be very simple. Sometimes there's some questions about what a primary residence means. For us, a primary residence is the home where you actively live. Let's say you work for the World Bank and you're buying a home in the Washington, D.C. area. You go to work at World Bank and you go home at night, and that's the home that you live in. That's your primary residence. A little aside, it comes up as a question frequently for our members who have duty stations all over the world. And let's say someone has a duty station in Nairobi and they want to buy a home in New York. What's a primary residence, Nairobi or New York? Ultimately, we certainly can figure all of these out, and we'll find a path that's amenable for everyone. So primary residences are available, of course. We offer mortgage loans for secondary homes. Could be a vacation home. So let's say you live in Washington, D.C., and you want to buy a vacation property on the beach in South Carolina. So that's a vacation home. Or let's say you live in Nairobi and you want to buy a home in Massachusetts, where you and your family will visit periodically and use it for your own personal uses. That's a secondary or vacation home is for a member's or an owner's own personal use. Separate from that is an investment property. So if you're buying an investment property, you don't have plans to live in that home. You're buying it strictly for investment purposes, for the rental income that you can derive from that property. Investment properties are very popular for us. We do a lot of investment property lending. These are important. These designations are important because they represent the occupancy for the home. And the occupancy has a big impact on the terms of the loan that you're going to be able to get. What that means is, really, it's a risk analysis or a risk view for us as a lender or any mortgage lender. Primary residences have the least risk for us as a lender. It's just very rare that someone would default on the payments for the home where they and their family live. So, for a primary residence, we give the greatest number of options, and we have the most liberal options for financing on a primary residence. Down payments can be minimal. Sometimes there's opportunities for, lower credit scores or higher debt to income ratios. All of these various qualifying factors are going to be looked at in the most liberal view with a primary residence. Down payment, as I mentioned, is going to be impacted by occupancy. Second homes or vacation properties really are very similar to primary residences. There is a slightly higher down payment requirement for a second home, but not major. Investment properties are a bit different. So with investment properties, we require a larger down payment. Typically, the minimum would be 20%. Depending on the type of property, it could be as much as 30%. All of these are questions or issues that your mortgage representative will be able to review with you in that first meeting or any subsequent meetings. The impacts of the occupancy of your property. Now that we've talked about how you own it, let's talk about this, the different types of properties that we finance. Of course, we offer mortgages on single family residences. That's like a house in the neighborhood with a driveway and the tree in the front yard and the white picket fence in the front porch. Single family residence, most common type of home ownership in the United States. We also offer mortgage loans on multifamily properties, which would mean a property that has 2, 3, or 4 units. These are very common in cities, urban areas. Let's say you want to buy a 3-family property in Brooklyn. You live in one unit and you rent out the other 2 units to tenants. It's a great way to make money, to make rental income off of the home that you live in, and that offsets your housing expenses. Of course, there's another conversation to be had about becoming the pros and cons of becoming a landlord, but those are discussions to have with your mortgage representative. UNSU also offers mortgage loans on condominiums or condos. So condos could be a high rise in Manhattan or Chicago or Dallas. On a suburban scale, it's typically more, say, of a townhouse style condominium or a garden style condo, maybe built around a golf course or tennis courts, other types of amenities. Owning a condominium is legally very, very similar to owning a single family residence or a multifamily residence, meaning you own the physical property, it's deeded property. You can do what you'd like to with this home, meaning you can renovate it, you can sell it to whomever, whenever you'd like. You can rent it out to a tenant if you ever chose to do that. Condominiums do have a homeowners association, and that homeowners association is responsible for the common elements or the shared elements of that property. So if it's a high rise in Manhattan, those shared elements would be the lobby, the elevators, the roof, the exterior of the building, the basketball court, or the gym. All of those common areas are maintained by the homeowners association, and you pay a fee that goes toward that upkeep. On a more suburban style condominium, homeowners associations exist, they're there, but they are less involved. The homeowners association is probably responsible for the lawns, the gardens, the plowing of the snow in the winter, maybe some exterior work. Um, but there is that homeowners association fee involved with any type of condominium. Now, we also offer mortgage loans on cooperative apartments, which are frequently called co-ops. Co-ops primarily exist in New York City. There are certainly co-ops in the near suburbs of New York. There's some in Washington, D.C., Boston, Chicago. They're most common in New York. I won't spend a lot of time on co-ops. because they are very specialized. But if you're familiar with a leasehold in the UK, a co-op functions most similarly to that. In a nutshell, a co-op, in a co-op, the building itself has become a corporation. So if any of you are familiar with Tudor City across the street from the UN, 5 Tudor City, 25 Tudor City, 45 Tudor City, each of those buildings is a separate corporation. When you buy an apartment in a co-op, you're not technically buying the apartment like you do with a condominium. Instead, you're buying shares in the corporation, just the same way that you would buy shares in Ford Motor Company or Coca-Cola or Apple. Ownership of the shares in the corporation gives you the right to occupy the apartment. I don't need to go too deep into all of this. If you're interested in buying in New York and you want to discuss a co-op, anyone's eligible to purchase a co-op, and we do a lot of co-op lending. I recommend that you speak with, again, both your mortgage representative and your real estate agent, especially because there are restrictions on your use of the co-op apartment, meaning most co-ops have restrictions on whether or not the property can be sublet, like could you rent it out to a tenant? Um, the board of directors is also actually quite involved in who buys, who can buy the property or the shares in the corporation, um, who it can be sold to. All of the buy and sell transaction involves the board of directors. So it is somewhat complicated. We deal with them every day. We're more than happy to work with you on co-ops. Most people end up buying a single or multifamily property or condominium. We work with all three all day, every day. So we've talked about what you can buy and how you can own it. I want to take a step back and discuss a mortgage pre-approval. You know, when you first meet with that mortgage representative on day one, and your mortgage rep conducts a pre-qualification for you. As I mentioned, that's just based on a conversation. And that's great. It's a fantastic starting point. But in the really competitive real estate world that we live in right now, you will probably be best served by having a more concrete or more formal step in this process, which is a pre-approval. I will tell you, pre-approvals are not obligatory on our part. So the credit union does not require that you be pre-approved for a mortgage. That said, a pre-approval will make you, as a buyer, a much, much more attractive candidate to a seller. With a pre-approval, once you've got a good idea of what it is that you want to purchase, maybe you haven't found the exact home yet, but you have a good idea of what it is you want to buy, you would submit an application for a particular dollar amount. We would document your income, your assets, all of those documents that we discussed before, the credit report. We would do everything except review a contract of sale and appraisal because you haven't found the specific home yet. We would fully underwrite, remember the underwriting team? We would fully underwrite this loan and issue to you a formal preliminary commitment letter or preliminary approval letter. And that letter says to a seller that as long as you find a satisfactory property, that your financing is already good. I can promise you, when Lisa is speaking later on in our event, she would agree that a pre-approval is, again, not a requirement, but very, very helpful for making your bid, your offer, as strategic and as attractive as possible to the seller. And if you think about it from the seller side, you've got two people who want to buy the home for $600,000. Buyer one says, I want to buy this home with $600,000. You're buyer two, and you say, I want to buy this home for $600,000. And here's my mortgage pre-approval letter that says all of my income, my assets, my credit has all been reviewed, and my lender has already approved me for this loan. That's definitely going to be a more attractive offer than poor old buyer one. So while we don't require the pre-approval, you very likely will be asked to provide one. There are certainly situations where a real estate agent or a seller may not want to um, entertain your bid or your offer without a pre-approval. So just be prepared for that. Okay, so you've been pre-approved. Now let's talk about the types of mortgages that are going to be available for you. The most common type of mortgage that we offer, that any mortgage lender offers, is a fixed rate mortgage. So with a fixed rate mortgage, it's exactly what it sounds like. You borrow a sum of money for anywhere from 10 to 30 years. 30-year loans are the most common and most popular type of loan, a mortgage loan in the US. They are spread out over the longest term, which means you pay us more interest. But because the payments are spread out over the longest term, the payments are lower, which helps on a month-to-month basis. It also allows you as a buyer to qualify for the largest loan amount, which frequently people are looking to do. Not in every case, but frequently. So again, the fixed rate mortgage is just what it sounds like. You borrow this money for 30 years and the interest rate never changes. So you always know exactly what your mortgage payment is going to be. These loans are really well received by people who have long-term ownership plans for a property. Let's say you're buying the home that you want to raise your kids in and have them all be in the same school district, in the same school system for the next however many 12, 15, 18 years. Or let's say this is the home that you want to retire in. The security and the safety ultimately of a fixed rate mortgage can be very, very attractive. We do have other options though. We have what are called adjustable rate mortgages, and that's what an ARM stands for. And as popular as fixed rate mortgages are throughout the industry, adjustable rate mortgages tend to be our most popular loans at UNFCU for a variety of reasons. The way these loans work is that you have a mortgage for 15 years or 30 years, again, typically 30 years. Instead of having the interest rate fixed for the whole 30 years, your interest rate is fixed for the first 3 years of the loan, or the first 5 years, or 7, or 10. The benefit to the adjustable rate mortgage is that for that initial period, 5 years or 7 years, whatever, the interest rate is lower than what it would have been on the fixed rate mortgage. So for someone who doesn't have plans to live in a home forever, frequently for our UN members, that is the case. Someone may plan to be in the New York area for 6 years and then, due to mobility issues, move on to another duty station. Why not take a lower interest rate for that amount of time? These loans are also attractive for someone who's looking to maximize the amount of money that they can borrow. That's not the best idea for everybody, but frequently it can be the case. If someone needs to borrow or wants to borrow the maximum amount that we can approve for them, the lower interest rate that's available on an adjustable rate mortgage allows that member or that borrower to qualify for a larger loan amount. Of course, there are risks that go along with this loan too, because after that initial fixed period, the interest rate is going to begin to change. It will change, and it will change every 6 months, and the rate can go up or down. There are caps on how much the interest rate can adjust per adjustment period and over the life of the loan. But the rate certainly can go up quite a bit, which would result in a higher monthly payment for you. So there are risks that go along with an adjustable rate mortgage. Let's go to the next slide and look at a comparison. We won't spend a lot of time on this, but let's say you have a $500,000 loan, and for the fixed rate mortgage, the interest rate, and this is strictly for example purposes, these are not true rates, but let's say the interest rate was 6.75%. So the monthly mortgage payment, the principal and interest payment on $500,000 would be just over $3,200 per month. On the adjustable rate mortgage, we've chosen one where the rate's fixed for 5 years. The interest rate is at 6%. In that case, the monthly payment drops to below $3,000. So what's that? A difference of $245 per month. Over 5 years, that would mean $14,700 in interest savings that you would not have paid to UNFCU on the adjustable rate mortgage. Important conversation for you to have with your mortgage representative. The stability and the predictability of a fixed rate mortgage versus the savings and the higher qualifying amounts for an adjustable rate mortgage. All great options. We're happy to review all of these with you and help you tailor the loan that's going to be best for you. Now, you can always, with whatever type of loan you take, we're not really talking about refinances in this event today, but you can refinance your mortgage. I'll make this less than a minute. When you refinance your mortgage, you take out a new mortgage loan to replace your old one. And people refinance for different reasons. It may be to get a lower interest rate. It could be to go from an adjustable rate to a fixed rate, or from a fixed rate to an adjustable rate. As interest rates go up and down, and they have really moved a lot over the past 5 years, up and down, people refinance for different reasons. But there are certainly ways for you to renegotiate the terms of your loan if that's beneficial to you in the future. Okay, so we talked about one of the questions after our last session was about closing costs. So let's talk about expenses in general. So, down payments. The amount of down payment that you are required to make, meaning the minimum that you're required to make, goes back to that occupancy type. So, if you're buying a primary residence, you might buy it with as little as 5% down payment. On a multifamily investment property, you could be required to make a down payment of 30%. So, on a $500,000 mortgage, a 5% down payment would be $25,000. A 30% down payment would be $150,000. So the down payment requirements vary a lot. Important conversation, of course, to have with your mortgage rep. In addition to your down payment, you are going to have other fees to pay. And someone had asked about this during our last Q&A session. Who pays for all of these different expenses? And most of them are paid by you. Some will be paid by the seller, but the majority of them are going to be paid by you. And like so many other things that we've discussed today, closing fees are going to vary depending on where you're buying. It can come down to the state or down to an even low micro level of the particular municipality, the particular town or city where you're buying. A $500,000 loan in New Jersey, your closing fees probably $12,000 to $15,000. In New York City, just across the river from New Jersey, and you're buying within the 5 boroughs of New York City, your closing fees could easily be $25,000 to $30,000. So that's a big difference. Some fees apply regardless of where you're buying an appraisal. We do that on whether you're buying in California or Florida or Maine. But the biggest ticket items are various mortgage taxes. So some states tax your mortgage, regardless of your immigration status or the type of visa you have. If you're buying real property, if you're buying real estate, you have to pay those mortgage taxes. They're more expensive in some areas than others. So that's information you can find online. Certainly your real estate agent, your mortgage rep. We're happy to help with some of those amounts up front so that you can be well prepared if you're buying in a high cost area. Speaking of calculations, I'm going to do a little plug for our website. We have a great mortgage calculator. And as you want to look at, if you'd like to look at these payments, just like we had that comparison of the fixed rate mortgage versus the adjustable rate mortgage, go online and use our mortgage loan calculator. It's a really great tool. And you can look at all the different scenarios that you'd like. I would also say use our website in general as a great resource. We've gathered frequently asked questions from our members over decades at this point, and basically have them all referenced in almost a library online of questions that our members ask. It's a huge amount of information that's out there, and if you really are getting serious about this and want to really dive into it, and feel like you're as well prepared as you can be from the beginning, I really recommend that you go online. Certainly use the calculator, but go into our frequently asked questions in the mortgage page of the website. Great resource for you to use. Okay, so let's talk a little bit about some special promotions that the credit union has. Again, as I mentioned, some of these are available all the time, and we have some that are special for right now. So these first few are credits and benefits that apply at all times. So in respect of our or out of respect for our green initiatives at UNFCU, we have a sustainable impact closing credit. So if you're buying an energy efficient home, then we'll give you a credit towards your closing fees for doing so. First time home buyers, always available with a first time home buying program. You can make as little as 5% down payment. We have some programs that actually allow a little bit greater flexibility on some of those other qualifying factors. I had already mentioned this a little bit. Maybe your credit score isn't as perfect, or maybe your debt to income ratio, your percentage of your income that's eaten up by your new mortgage payment, maybe it's a little bit higher than typical. These programs have some allowances specifically for first-time home buyers. And on top of that, we'll also give you another credit towards your closing fees. Having a mortgage loan also makes you eligible for our member loyalty rewards program. So um, the loan balance, the amount of your loan balance, is going to make you eligible for UNFC rebates, extra dividends, and all sorts of rewards. Now, I'm excited about these because we've got two brand new promotions, and this first one is the first time we've ever done this. I mean, I've been at the credit union almost 25 years, and we've never offered something like this. This is a limited time offer. So, for someone who purchases in the next few months, you can read all of the details. Um, and you close on your mortgage loan. If interest rates drop within the next 12 months, we'll float your rate down. We'll drop the interest rate from whatever your original rate was here at the time of purchase to the then current interest rate. That's a $1,500 savings, because typically we charge a $1,500 fee for a member to modify their interest rate to move from a higher rate to a lower rate. So that's a great deal. No one has a crystal ball. I wish I did, but I can't tell you. But there is a lot of anticipation that mortgage rates might go down in 2026. We don't know that for sure. But if it's the case, this is the perfect time to have this great offer for a free interest rate modification. So I'm really excited, and I hope a lot of you will take advantage of that. The next one is specifically for you, our attendees for this event. So as a thank you, um, the first 15 attendees who submit a qualified mortgage application will get a $1,000 bonus from UNFCU. Upon closing, we're simply going to deposit $1,000 into your savings account. I mean, our idea is that you'll use it for moving expenses, but really you can use it for whatever you like. It's our thank you to you for spending your time with us, and considering UNFCU for your home financing. And thank you. We're going to wrap up this portion of today's event. with some opportunities for you to use your home in the future for other needs. So once you own your home, over time, as your mortgage balance decreases, you're paying down the balance, and as your home appreciates in value, homes don't always appreciate; they can depreciate, but over a long history, real estate typically appreciates in value. So as the home appreciates and your balance drops, you're building equity in your home. So let's say your home is worth $500,000 and you have a mortgage balance of $300,000. That difference of $200,000, that's your equity in the home. And there are great and very popular mortgage programs, mortgage plans that allow you to borrow against that equity in your home. If we go to the next slide, yeah. So typically you would borrow that money in the form of a home equity line of credit or a home equity loan. Again, these are super popular. Um, the way a home equity line of credit or HELOC works, we open up a line of credit for you. Let's say it's $50,000 or $100,000. We do HELOCs of up to $500,000. It depends on how much equity you have in your home. We open up the line of credit and it's a revolving account. So you can pull money out of the line of credit whenever you need to or whenever you'd like to. And you can use it for whatever you would like. Many people use it for home improvements or renovations, putting in a swimming pool, putting on a new roof. It could be for education expenses, whatever other family expenses that you may have, or just needs in general. A lot of people like to have a home equity line of credit just for the security of having it in case you ever needed to tap into the equity in your home. You'd already have it lined up. There's two different payment options. You can go a traditional route where you would make a principal and interest payment for your HELOC. We also have an interest only option, which has proven to be very popular. So you only pay the interest each month on the balance of the equity line that you've used. Great deal. For someone who's a little bit more conservative, we also offer a home equity loan. So with a home equity loan, you borrow a lump sum of money with a fixed interest rate for a fixed term, and you simply pay the money back over the next 10 years or 15 years or 20 years. Whichever product you choose, these are very popular. It's a great way for you to finance other needs at a much lower interest rate, certainly than what you would pay on a credit card or on any other type of just signature or personal loan. Because just as with the purchase mortgage, home equity lines of credit and home equity loans are secured by your home, and secured loans have the lowest interest rates. So these are a great option for some time down the road. Our last slide today, and or at least in this section, is not technically about mortgages, but I would be remiss if I did not bring it up. The credit union has a really unique program, incredibly popular with our members. It's specifically for UN staff members, but we have an international home loan. This is a loan designed specifically to purchase or build a home outside of the United States. You can use it anywhere in the world. Of course, you'd want to check to see how the terms of this loan compare to the terms that you may be able to get locally. But for a lot of our members who want to buy, whether in their home country or where they're going to be stationed for some time, it's a great opportunity, and it's a very unique program, and it was developed over quite a few years of listening to our members tell us this is something that they really wanted. And I'm very proud of the credit union for developing this unique program that I don't know any other lender in the United States who has such a program. So if you're interested in buying a home outside of the United States, and hopefully in the United States too, but if you are interested, please go to our website and look up this international home loan. I think that you'll find it very, very interesting. So thanks for your time. Sylvia is going to come back and we'll try to answer some more questions for you.
Thank you, Chip. A wealth of even more information for our viewers. I do definitely want to thank you for referencing our website and the FAQs that we have gathered throughout the years. It is an abundance of resources available to all. We also do have quite a number of additional questions for you. And first up, we have if UNFCU member is a homemaker, so has assets but no income coming in, and the non-member spouse is the income earner, can the spouse of the UNFCU member get a mortgage through us as an individual, or would UNFCU only provide a mortgage to them as a couple?
Wow, that brings up quite a few questions. I'll try to make it quick because we've got a lot of questions, but this is a great one. A couple things. One, UNFCU membership is open to anyone. Back when I started in the year 2000, credit union membership was limited to UN staff members and their families. Now anyone, anywhere can join UNFCU. Certainly spouses are still welcome to join. In this member's particular case, you really have the choice to structure a purchase however you'd like. As a non-income earning spouse, you could still be joint on the loan. That's fine. Some married couples like both to be on the application, even if only one is earning that income. We could do it in the income earning spouse's name only. That's also fine. I do want to take one step back. Some of it could depend on the state. So, for example, California is what's called a community property state. If you were buying there and you're a married couple, you have to buy jointly. That's not a UNFCU issue. That's a state law issue in California and some other states in the US. Barring those restrictions, you can really structure this however you'd like to. Whatever is most advantageous for you, we would be happy to make it work.
Excellent. It's nice to hear that there are options to realize those dreams. So you did mention some programs. So how about those who have zero down payment? It's been heard that there exists a program which can help first-time home buyers, and you talked a little bit about that with their down payment, and they want to know how much truth is there?
Listen, there are programs out there in the marketplace that offer 100% financing. They're not as common as they have been at different times. Say in the early 2000s, just before the Great Recession, there were a lot of 100% financing programs out there. Most of them went away. The majority of 100% financed loans are now available through the federal government. We don't really offer that many of those types of loans. The main reason being that many of our members who are not U.S. citizens or permanent residents aren't really necessarily eligible for those loans. And so it just doesn't make a lot of sense for us to focus on them. For us, the minimum down payment would end up being 5%. Now, can you research grant programs? Yes, we have a grant program that can allow even up to $30,000 for eligible members and eligible applicants, and that money can be used for expenses, down payment, etc. It typically would not provide 100% financing, but it would go a long way toward it. So, certainly discuss with a mortgage representative. Um, I guess sort of maybe disappointingly, I have to say that there are 100% financing or no down payment loans out there. They're not as common as they used to be, and we don't offer them.
Gotcha. Okay. So our next question from a member is, given this, does that some are outside of the US, does credit score impact interest rates? And how and by how much, if you can shed some color on that?
Sure, credit is over my many years at UNFCU is always a source of mystery and question. So, if you don't have a credit profile in the US, it's fine. We can work with you on developing an alternative credit profile. Typically, that means things like a landlord reference letter verifying that you've paid rent on time, or perhaps you have a cell phone plan from, I don't know, Switzerland or from Uganda or from Japan. I mean, you can show proof that you've paid your cell phone bills or proof that you paid your electric bill, utilities, whatever it may be. We're very creative in finding information that can help develop that alternative credit profile for us. Now, the bigger question, or a question, how does the score impact your loan? Now, we have a variety of programs where the credit score doesn't impact the interest rate at all. So, whether you have zero credit because you don't have a credit profile at all, or maybe your credit's not perfect, or maybe your credit is excellent, 820. Some of these loan programs have interest rates that are the same regardless. Now, we do have some loans, particularly our fixed rate mortgage products, not all, but the majority of them, where credit score does impact the rate. And so someone with no credit may not even necessarily be eligible. You may have to go with one of our adjustable rate products. Um, we've always tried to maintain a set of attractive loan programs. As I mentioned, the adjustable rate mortgages are our most popular and most common types of loans that are available regardless of credit score for our members. Some of our other products are credit score based or focused. So we would help you, pick and choose and review and decide which of these programs would work best for you. We definitely can work around it. I've never seen a case where now someone could have really poor credit. Now that's different. If you have a very low credit score because you haven't been very good at paying your bills on time, that's different. You may not be eligible for a mortgage because of that. But if you have no credit score or a low credit score because of a limited credit profile, I've never seen a situation in all my years at UNFCU that we couldn't find a way to make a loan work for that person.
That's good to hear. We are coming up on time, but I do want to give the attendees some insight on how would they go about submitting a mortgage application? Because you did mention that promotion that we have going on for the first 15.
Yeah. Okay. Um, Certainly, the fastest way to apply is online using that our unfcu.org website. Um, go to the borrow tab and then you click on US mortgages. Regardless of where you live or where you are located, you would choose buying a home in the US. And once you've clicked onto that, it will take you to a link to select a mortgage representative, depending on your relationship to the credit union, and take you right into the application.
All right, great. Thank you. So that wraps up our home buying process session. We're going to take our second 5-minute break. And when we return, we'll bring Catherine in to share some information on the benefits that you get as a member of UNFCU. We'll see you in 5.